What's up, everybody? Joe Brown with Heresy Financial. The Federal Reserve just released their FOMC statement about 10 minutes ago. Want to go over it briefly with you guys here, look at what it says, and then in about 20 minutes, Powell will be giving his press conference and answering questions to the press about the statement here, and so we'll get a little bit more info. So, first of all here, let's take a look, and he's citing the sharp rise in COVID-19 cases, the Omicron variant, and he said job gains have been solid in recent months. Unemployment rate has declined substantially. I'd like to point your attention here to the United States labor force participation rate, and we can see here it is still well below what we were at for years prior to March of 2020. So a little bit of a rebound there in the labor force participation rate, but nothing close to where we were before. All right, so let's keep on going. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. Again, supply and demand, I get it, always causes, that is what drives prices, but where did that demand come from? Might it have something to do with the unprecedented spike in the money supply, the expansion of the total money supply there? All right, overall financial conditions remain accommodative. That is true. Accommodative means the Fed is assisting the economy, injecting money through things like asset purchases, keeping rates low, in part reflecting monetary policy measures to support the economy and the flow of credit. Okay. The path of the economy continues to depend on the virus. Let's see here. Okay, this is the meat and potatoes. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. Those are their dual mandates from Congress: maximum employment, and it's really stable prices, and they interpret that as 2%. Even though 2% is rising prices, stable prices should be not rising prices. But over the long run, that's their target. And they've decided to keep the target range for interest rates, which is the federal funds rate, at the low end, 0 to 0.25%. So no change there on interest rates. And interest rates are a more powerful tool there to try and cause the economy to stimulate more inflation or cause deflation or whatever. Rates are more powerful than asset purchases, most would say. With inflation well above the 2% target and a strong labor market. Again, this is the labor market. This is what they're calling a strong labor market here. The committee expects it will soon be appropriate to raise the target range for the federal funds rate. So they're saying soon we'll raise rates, but no date yet on when. The committee also has decided to continue to reduce the monthly pace of its net asset purchases, bringing them to an end in early March. So I believe that's a change. I believe it used to just say sometime in March, and now they're saying early March. Beginning in February, they're only going to be buying $20 billion worth of treasuries and $10 billion worth of mortgage-backed securities. And again, I have to say this every time because my comments blow up with this. Oh, it says at least. That means they're buying way more. No, it doesn't. Go look at it. Add it up yourself. They're buying what they're saying they're buying. For 15 months, they bought less than $120 billion on average for 15 months per month. And so they're sticking to it, especially when they're saying they're going to bring them to an end in early March. That's not at least an end. They're going to bring them to an end in early March. Again, all this will go out the window if Bank of America suddenly needs a bailout, declares they're insolvent, or Deutsche Bank starts knocking over banks in the Eurozone. All this will go out the window. But right now, that's a plan, and they're not going to, they're ending in March. That's what they're doing here. They are tapering, and they are going to end their purchases here. The Federal Reserve's ongoing purchases and holdings of securities will continue to foster smooth market functioning, accommodative financial conditions, supporting flow of credit to households and businesses. And to continue making sure that they're doing the appropriate thing, they will continue to monitor the implications of incoming information. Again, are any too big to fail firms, financial institutions going to start knocking and falling over like dominoes? That's what they're talking about there. They're not talking about the stock market falling, people's brokerage accounts and 401ks, being read every single day. And they allude to that here. They said they would adjust the stance of their monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. So what are the goals? stable prices and maximum employment. So you start to have too big to fail firms going under. They're going to do, rescue that in order to make sure that employment stays where it's at, even though it's not great. They don't want another plummet here. And inflation, they'll push that to the side like they always had in order to make sure that the economy doesn't completely implode and collapse, because they always fear deflation more than they fear inflation. So how have the markets responded to this? Well, this is a minute chart here, and so day starts right here. You can see the market was moving pretty much sideways, spiked up a tad bit on the initial release, and then has sold off a tad bit. If we move over to a 1-day chart, we can see absolutely flat. I mean, that's no movement when you're looking at it, over the course of the last couple of months. And then Nasdaq, a little bit stronger. We're seeing a continued rebound here with some more strength out of the Nasdaq. Let's take a look at the Dow. Flat, just like the S&P 500, maybe a little bit lower. And then the Russell 2000 were up a little bit more. What has gold done? Gold has sold off a tad bit, expectedly. Usually on the days where the Federal Reserve comes out and says anything, regardless of what they say, we get a little bit of a sell-off in gold. But that sell-off has largely recovered here. The one that started selling off right at the release of the statement. If we look at silver, we're getting a similar price action out of silver. We saw a little bit of sell-off and rebounded so far. And Bitcoin, we got a big jump, and then it has sold off back to where it was before that jump. If we go ahead and look back at the daily chart, again, fairly flat, still at 37,000. We're kind of rebounding off of this $33,000 low from a couple of days ago. The dollar. If we look at the minute chart, we can just see some more volatility here out of the dollar. And then let's start to take a look at what rates have done as a result of the statement. Pretty much nothing. Little spike today, fall back down for the 2-year, 10-year, a little bit of rallying. Same with the 20, and same with the 30. Basically flat here, not a lot of movement. And then oil today, we're seeing a good rise out of oil, and most of that probably has to do with escalating tensions in Europe, Eastern Europe, with Russia. So that's what's going on right here. Looks like the market has really absorbed most of the blow from the anticipation of tighter monetary policy. There were no surprises. They didn't come out more hawkish, other than maybe moving from March to early March on finishing up with their asset purchases, and made no mention of of tapering their actual balance sheet, starting to sell assets, quantitative tightening, although I'm sure that question will be brought up in the press conference and Powell will have to answer about that. And so we'll see how the market responds through the rest of that. I'll watch that and then post another video with any highlights from that question and answer time. As always, thank you so much for watching. You guys have a great day.